for the folks who don't, I'm David Bank. I have the privilege to co-lead ImpactAlpha. We have a 5-morning-a-week brief on all things impact investing and sustainable finance, and podcasts and conference calls and Slack channels and everything else. So please join us. My colleagues are here, so they'd take me to task if I don't say that there's a special offer if you want to at impactalpha.com/SOCAP. So check us out. Let me introduce each of you, and then I'll just say a little bit about our work with C3 and Catalytic Capital. But Urmi Sengupta from the MacArthur Foundation, I just learned that she became recently, or a few years ago, became a U.S. citizen, but this is the first election she'll be able to vote in. You can talk to her about, you can chat with her privately about who she's voting for.
Or publicly.
Daniel Wanjira from Blue Haven Initiative, who is fresh apparently from Iceland, where he was hunting the elusive puffins as a bird watcher. Is that right? Not hunting them, hunting to spot them and put them in his. There's a kind of book that you keep, right, of all the birds you've seen?
Yes.
Yeah. And an old friend, Greg Neichin from Ceniarth, who's actually local here, and who is a long distance and mountain and every other kind of biker apparently, and I think has something like 10 bikes, 12 bikes in your garage? Yeah, okay. So they're all been terrific partners and sources and colleagues through this. In particular, C3 and MacArthur, and we at ImpactAlpha have been working with them for a bunch of years now, and specifically around Catalytic Capital. And I will say, when we first started, there was people would talk about concessionary capital or below market capital, and they would sort of sneer and say subsidized or subsidies, and it was kind of all of it has sort of a down kind of cast to it, and we hooked on with the folks and Urmi's colleague Deborah Schwartz and this whole Catalytic Capital framing, which is innovative and smart and strategic, and has, I think, really taken hold. And if you just watch kind of Google Trends of the term, it's been adopted, and we hear it now back from folks in all kinds of different contexts. I mean, I think Amazon uses it in some ways in their fund and stuff. So we've really been very gratified that now it's got a sort of up market, and you have the privilege of being the part of the deal that made the rest of it work. We also have been interested to know that in our reader surveys, it always comes out at or near the top of what folks are interested in, and it's very much our sweet spot, because it's all the wonky sort of financial innovation and financial engineering that makes not only for good deals but also for good stories for us. So we're very appreciative of the partnership and of the work itself.
Well, if it's trending on Google, we're good. We got to
go. So let's just. I will say also, if you did read your brief, as Mark was saying this morning, you see that Urmi had a guest post and Greg had a guest post. So it's all live, and what they were talking about is this announcement and decision that the C3 initiative, Catalytic Capital Consortium, has come to extend the lifespan. So many of us, I just came back from the GIN in Amsterdam, but the previous GIN in Copenhagen last year, there was a meeting of the Catalytic Capital crowd, and everybody was very sad because the initiative was winding down. But there was definitely a feeling that the community needed to continue to be sort of rallied and convened. And I think maybe out of that meeting, some new funders came forward. So part of the reason for this panel and the sort of news hook, as it were, is that the C3 initiative has new life, and they'll be continuing to do the good work of field building. And I see Harvey Koh sitting here in front row, and he's been instrumental also in sort of bringing the learnings and of that whole process together. So Urmi can talk more about that. In fact, why don't we just jump off with that, Urmi, and say what's going on with C3?
Thank you, David. Wonderful to be here, and so excited to see lots of friends and partners here and lots of new faces. So more folks that we are going to have join the Catalytic Capital community, hopefully after this. As David mentioned, Catalytic Capital plays a very critical role in helping address the needs of enterprises that may be working on social and environmental needs, but don't really warrant market rate capital, or those that are early stage and have not yet proven their worth and need some hand-holding while they get to scale and they're able to attract more commercial money. In these cases and others, Catalytic Capital has a very critical role to play. We think of it as patient and flexible capital that is focused on helping create impact that would otherwise not be possible, and to bring in investors who are looking to participate in these transactions but are not really able to come in with a more flexible type of capital in these transactions. So that's where Catalytic Capital has a big role to play. In 2019, we at MacArthur, along with partners at Urmi Network and Rockefeller Foundation, started the Catalytic Capital Consortium. The idea was that it was a learning and market development initiative, and we focused on helping increase the knowledge, awareness, and use of catalytic capital in the field globally. Through the years, we have focused on two broad areas. The first is MacArthur committed about 123 million in investment capital that went to global companies that were, or funds that were working on catalytic capital and demonstrating the use and contributions of this kind of money. This investment has happened across sectors, across regions, and across different types of entities. Most often, the recipients are funds. We have brought in partners and co-investors who span the spectrum of DFIs all the way to small family offices, in some cases, local financial institutions as well. And the second piece of what we have done is focused on field building. This is all a set of activities that we have embarked on through the last few years in order to help investors get more familiar with catalytic capital and deploy it more actively and efficiently. I see lots of grantees and partners here. I'm sitting here. I know others are at the conference today. These activities have led us to make about 26 grants over a period of 3 years. And we've partnered with 8 networks, 4 of them based in the US and 4 internationally, in order to take the catalytic capital knowledge and resources that we are developing to their audiences and members. We've also developed a global community of leading practitioners and investors that are continuing to work with each other. And Greg mentions the Dealmakers Roundtable in his piece today on ImpactAlpha. And we have continued to aggregate best practices through the years. So that's a little bit of what we've done. We'll talk about where we are headed in a bit.
Daniel, Blue Haven Initiative, many folks know, is the family office and investment arm for Liesl and Ian Pritzker-Simmons. But I had always thought of the strategy as a market rate strategy, and specifically so to sort of demonstrate that there were market rate returns. But now I know you've expanded that. So maybe tell us the journey and the process of the thought process.
Yes, thanks for that. So Blue Haven Initiative, Impact Investing Family Office, and for about 13 years now, we've been deploying capital across different asset classes with a focus on market rate investment. A huge majority of our allocation right now is still in market rate. But over the years, we've recognized the need of having philanthropic capital, especially in building markets. And so we started about 5 years ago with the help of my colleague Megan, an initiatives portfolio where we deploy grants and catalytic capital in the impact ecosystem. And we use this for 2 main purposes. At the surface level is building the infrastructure of impact investing. So we work with a lot of organizations that are working on refining impact measurement and management, or public policy, or bringing impact investors together. So think of the GIN or the C3. But on a deeper level, we're working on addressing market pain points that commercial capital is not addressing. And this includes stuff like working with emerging asset managers who are having challenges bringing their funds to market. So providing them with the catalytic capital, with their housing capital that enables them build a track record and prove their strategy so that they're able to attract commercial capital. We're also working a lot with early climate innovation, so think of first-of-a-kind climate innovation that are at a point where the product is, has a high promise for impact, but the team hasn't quite gotten to a point where venture dollars or even project finance is attracted to this project. And so we come in very early, provide the type of capital that these teams can use to get to, attract commercial capital. And so over the years, we found that working very closely between the philanthropic side of the house, which I lead, with our market rate teams, we're able to identify pain points through our market rate teams, address that with our commercial capital, and then the market rate teams comes later on and fills the gaps during this later stage. So even though we've made like a slight shift toward providing philanthropic capital, we're still doubling down on deploying market rate capital, but recognizing the impact of having grants as well as catalytic capital in building markets.
Thanks. And Greg, we can always count on at ImpactAlpha for some provocative posts, and I think you've had, I don't know, at least half a dozen over time. And one of the things you take on is not just the inequities in the what we call the legacy, or what people are now calling TradFi, but also some of the contradictions in the impact world and in the responsible investing world. And you guys are explicitly impact first, and now I think proudly catalytic as well. So just tell us how you think about it.
Thanks, David, and thanks to everyone who's in the audience. We're at the kind of end of SOCAP, so appreciate everyone showing up. We've been on this decade journey at Ceniarth, where the single-family office of Diane Eisenberg. We started about 11 years. We started looking quite broadly with a North Star to invest in improving livelihoods in marginalized and vulnerable communities globally, but with a broad mandate to do everything from finance first impact investing to the highest risk program related investments we could find. And I think, over time, we just recognized that in the places and communities we wanted to invest, the double bottom line sort of theory was not playing out. It just simply wasn't getting capital into the hardest to reach places. It might serve a perfectly fine purpose in the world. It might be more responsible. It might be good. I'm sure it is good, but it's not touching the people and places that we and Diane wanted her capital to be directed toward. So about 5 years ago, she set out. She set out a marker to say, can we move the entirety of our portfolio, which is around $700 million, into impact first investments, not responsible, strictly impact first. We're about 50% of the way there now. We deploy $60 or $70 million a year in impact first investments. It's about 20 or 30 transactions a year across both funds and directs. So that's kind of how we arrived at leaning into impact first. Catalytic Capital, it's worked as a name. The thing is, one of the things I wrote about today was why did we get involved in Catalytic Capital? The number one thing we wrote was because nobody's listening to us. We're a provocative, sort of bombastic family office. We've been doing this for 10 years. We've been advocating, pushing this boulder up a hill. And yes, we have had great wins over the decade. We've had a handful of other very large family offices join us on this journey, have contributed hundreds of millions of dollars to this movement. That's awesome and wonderful, but it's been sparse in terms of our number of collaborators. And so I think that for us, sort of joining this catalytic capital movement has really been about attaching ourselves to the professionalism and sort of institutionalism, not in a bad way, the sort of institutionalism of our foundation, brothers and sisters who can do this in a way that speaks more broadly, speaks to folks who have to navigate more complicated board environments and guardrails and all these things that we blessedly do not have to deal with. So I can talk a lot more in detail about the why behind all of this, but in the end, these words, they don't matter. Like impact first, catalytic, it actually doesn't matter. What matters is our dollars getting into communities in need. So people can call it whatever you want, as long as you bring dollars into hard to reach places.
Well, okay, let's see, Actually, I was mentioning when we had our prep call, you know, both Ceniarth and Blue Haven, and also Builder's Vision. I should mention that, I guess he's been already removed here, but we were going to have James Lindsay from Builder's Vision, and he had a family emergency, so that was, I think, in the program, but we've improvised. And all, in some sense, are family offices. And I said, oh, that's interesting, because family offices were always considered the probably low-hanging fruit of catalytic capital. People are making their own decisions about their money and not being fiduciaries for others. And then, Greg, you made an interesting point, which is, well, we don't really want the family offices. We want the big foundations. We want the big institutions. We want the DFIs. We want the pension funds. And so how is it playing out? Maybe, Urmi, you have a field level sense, but any of you, how is it playing out? Are people coming in? Are people understanding it? Is it working, to your point?
I can take a shot at what we're seeing at C3. And the interest and engagement is just phenomenal. You know, we started out by saying we would do this for 3 or 4 years. We got to the point last year when we were trying to wrap up, and there was tremendous interest. You're seeing, you know, 2 funding partners that have joined us as C3, but even beyond that, we are seeing interest from investors across the world in many, many different markets, and we're very grateful to the impact investing networks that we are partnering with, because those are surfacing some of these conversations. In the US, we see a lot of that firsthand. MacArthur has been making catalytic capital investments for over 40 years. So we have a very, very deep network in the US of colleagues and other organizations that have come into catalytic capital and catalytic investing over the years. The interest is huge. You know, but David, it also talks to then the challenges of sort of how to translate that interest into actual investments on the ground and deployment, which is what Greg was talking about. And I think that's where the sort of C3 thesis of helping investors acquire a range of resources, tools, knowledge, share information on what has worked in certain markets, what do we know about catalytic capital deployment, and then creating structures and some sort of pathways for investors to learn of deals, to participate with others, to be able to share this internally when they have internal structures that require them to change how they approach their investing ability or their priorities. They have some degree of guidance on how others have done it before them. So all of these things become very important, and that's what has motivated us to continue on this journey.
And I think one of the really good things that C3 did in the first phase is building these communities of practice. Blue Haven joined the communities of practice in the earlier days, and we've seen how that community has grown to the point where now there are different subgroups that are coming up, you know, subgroups that are interested in oceans, for instance, in emerging managers, and in other thematic areas. And so it's been impressive just to see the interest as well as, you know, the intentionality and collaboration that is coming out of these subgroups.
Yeah, and I'll also note that flowing out of those working groups, and this is something we also wrote about this morning, was something we raised our hand to lead was something called the Catalytic Capital Dealmakers Roundtable, which is about 20 of us, foundations, family offices, DFIs, that are all active catalytic capital practitioners. And we meet quarterly, we exchange deal flow. We've looked at about 60 deals together over the course of this year. So I think that you know, one of the downsides of some of these initiatives is often they just become sort of talk shops and produce white papers, and I don't, that in and of itself it's good to generate insights and practical educational materials. But at the end of the day, we're all trying to move money into the field. And I think it's important to note that this initiative not only has produced really interesting educational insights, it's producing actual active collaboration and capital into the world. And MacArthur themselves has put a lot of money out into the field through their direct investments in the first phase. And now I think it's incumbent on a lot of us to sort of pick that up and collaborate to put even more capital out.
Well, let's go one deeper on collaboration, because as you say, it's not just sort of having the idea or even the willingness to do catalytic capital, but these deals are complicated. There's many layers, and there's junior and senior tranches, and it has to be staged. And I know that, for example, one initiative that's on this point, folks may want to do a catalytic deal but don't have the capacity in their own organizations. I know TrimTab is trying to address that, to be able to, similar to this, bring deals together and present opportunities. So Daniel, maybe you want to discuss that idea?
Yeah, for Blue Haven, we've been deploying Catalytic Capital for a number of years now. And as we're doing this, we get to interact with a couple of family offices and other private investors who are interested in the space, but they're not, they don't know quite how to do it. And in the past 3 years, we've been obsessed with the challenge of how do we actually unlock this private capital from family offices and other investors who are interested in participating here, but don't have the avenues to do this. And so we partnered with the Impact, MacArthur, and other family offices to set up a new structure that is providing catalytic capital to innovative fund structures globally. From the Blue Haven perspective, this is one of our favorite investments that we've made, because we have been involved in it for the past 3 years. And the way that we look at it is we divided it into 3 sections. So there was the ideation side of things, the incubation, and execution. And all of these 3 different phases, they represent how you can use philanthropic capital to bring new intermediaries and new initiatives to the market. On the ideation front, as Blue Haven, we provided grant funding, as well as MacArthur Foundation and a couple of other partners, to, first of all, conducted research on the consensus around, are there actually family offices, is there private capital that is interested in catalytic capital? And then beyond that, dig deeper and check, if we were to mobilize private capital from family offices, what type of structures can receive the different types of capital, from DAFs, from foundations, from LLCs, from offshore trust, and is that available in the market, or do we need to come up with that? So in the ideation phase, answering those 2 questions, is there consensus, is there a structure that can receive this capital and redeploy that? And to do that kind of work, you need grant funding, you need research to be able to do that. And then once we got to a point where we had an intermediary, we had a structure that we thought this could work, we had to get into the next phase where to prove this strategy. And so from a Blue Haven perspective, it's more about providing the warehousing capital, catalytic capital, to build a track record around this investment strategy and socialize that idea, have a portfolio that we can demonstrate to potential investors that, hey, this is something that we think is a game changer, that's something that we think that is going to be highly catalytic to the impact space. And then after the incubation phase enters now the execution phase, where we're moving now from just looking at this challenge from a grants perspective, from a research perspective, from thinking about from an incubation perspective, from a warehousing perspective, a catalytic capital perspective, and now in terms of how do we actually make this into an investment that Blue Haven can participate. And the reason I like sharing about TrimTab and this specific project is because it demonstrates how, as an impact investor, who has the ability to write philanthropic capital, you can use these different tools to support a project on different phases. So from grant financing, warehousing capital, to participating as an investor. And I think one of the challenges in the catalytic capital space is that sometimes we think that if we create something, the market is going to receive it, the but-for argument. And sometimes it's easy to assume that market is just waiting for you to create it, and then they're going to take it, and not having that clear through line that, hey, I want to support this project from the early days until a point where it's a fully fledged project, a fully fledged program, a fully fledged structure, intermediary that demonstrates the power of catalytic capital. And I think that's what we've done with TrimTab, and the team, I see Trace, part of the audience, can speak more towards how we're changing the field of impact investing with this intermediary.
Great. The other source of catalytic capital that folks have always sort of eyed as something to bring into the field is the development finance institutions around the world. And they are sort of quasi-public banks and lenders, and they're charged with a sort of development mandate. But in large part, over time they've been acted more like commercial investors. Recently, there's been a lot of pressure, if you've been following through the various COP discussions and other things at the World Bank, to try to get them to play this more catalytic role. And I remember a conversation with Diane, and Ceniarth had done a deal where it was taking the risk so that the Development Finance Corp, which is the U.S. Development Finance Institution, would come in. And so she was saying, why does our little family office have to guarantee the U.S. government? But I think there has been some motion as the pressure has built on those guys.
Yeah, there has, and I think the development institutions have been a real bright spot over the last 3 to 5 years. Unlike some corners of this broad impact investing universe that can graduate to commercial capital, the world we inhabit, we never, that is not an exit for us. I mean, we don't think about the sustaining phase of most of the things we do to be, and then green pastures will arrive and TPG will want to invest in it. Like that's just not, that's not the trajectory. The trajectory for us is really, government funding or development finance funding or major philanthropist funding. There's all sorts of other multi-trillion-dollar pools of capital that are not commercial capital that can support long-term sustaining investment. So, yeah, the development banks have been great. They are leaning more into some junior positions now, as opposed to just being senior loan capital, which they traditionally inhabited. So both, we're in deals where the DFC has taken a junior position in funds like Global Partnerships, new fund. We've been an investor with Global Partnerships for a number of deals. The deal David was talking about was one where we were the junior tranche, and DFC and FMO were above us. So that's flip-flopped in the latest Global Partnerships fund. But there's loads of examples. KfW, the German development bank, has sort of catalyzed a number of different interesting funds we've been in. Blue Orchard's Climate Insurance Fund is one that comes to mind, where they put in a huge slug of first loss capital to sort of de-risk the senior tranche. The amazing thing is in a lot of these cases where a development institution might put in an unreasonable amount of first loss capital, they still have a really hard time raising senior money on top of it. So there's a lot of times where private investors and foundations can come in and earn highly de-risked returns, still be catalytic, because actually you're catalytic because even though it's been entirely de-risked, no one else is going to do it. So I think that's a big opportunity for folks who are trying to get into this like in an easier way.
Are there cases, you mentioned risk, and risk sort of at the heart of all this, and folks sometimes think, it's mispriced risk, and if people knew more about the market or there was a track record, that those risk concerns would go away. There's other cases where it seems like it doesn't even matter how much catalytic capital is in there, that folks won't think it's too risky anyway, whether they're right or wrong. But sort of how do you think about this risk perception question, and how that can be mitigated over time so that these things do become commercial?
I think that it can be mitigated over time with good data on whatever one's investing in, credit performance or asset performance over time, such that by the time you're on fund 3 or 4, you've got reams of data to demonstrate to the senior investors in that facility that a 5 or 10% first loss buffer is plenty sufficient to de-risk. I think in the earlier stages of funds, and I'm looking at Justin Schwartz from Impacto because I literally had this conversation with him yesterday about like what is the right amount of first loss in some of these vehicles. Sometimes for very early funds, the right amount is an unreasonable amount, you know, and I know that feels unsatisfying as an early stage fund manager to say, why do I need 50% of my fund in this junior catalytic thing? I can show you I've done these pilot deals, they're working, they're fine. You know, all I can say is like, it's hard enough to get most folks into that $10 million fund. So having an unreasonable amount of protection, even for some of us who are leaning into these things, is useful to getting us over the hump to participate in those very early funds, and then hopefully over time that rationalizes.
Right. Another interesting, I think, change or shift over in recent years is, you know, folks think of, oh, the catalytic investor comes in and provides this first loss or some kind of guarantee, and that attracts or crowds in a commercial investor. I think in the SDG loan fund, which is one of the examples we love, the impetus, or at least a large part of the impetus, came from the institutional investor, in that case Allianz, the big German insurance company, and they wanted to invest in emerging markets and the things that would advance the sustainable development goals. They, you know, I presume some internal champion had to get it through their investment committee, and so they came looking for partners that would help de-risk it. Maybe you just want to briefly sketch that out.
Yeah, thanks, David. This is true, but I will say, you know, this has not been the norm, and this was a very promising development. My colleague Deborah Schwartz, whom David mentioned, who leads our impact investments team at MacArthur, worked on this transaction. It took her and a whole lot of colleagues across MacArthur and the other two leading actors here almost 4 years to put it together. But all this to say, I think there is a lot of learning and lessons involved in this, and we're already seeing a lot of different actors coming forward and saying yes, and they are not always the institutional investor, but sometimes they are, who are saying we want to be part of deals like this. How do we go about structuring and designing this? What have you learned about what's easiest to get through various approval lines and what is going to move the fastest? So I think there is interest, and I think that even from the DFIs, going back to your previous conversation, David, we have heard a lot of commentary on how there is this gap between investors that could be in blended transactions and that are much more commercial, wanting to come in but not really knowing how and not knowing the pathways. So one of the things that we hope the work from C3 will illuminate is a little bit more of this, of how you are able to think about opportunities where institutional and other private investors can come in and can come in at scale, and what designing that entails. The idea of C3 started many years ago, you know, as sort of the MacArthur team saw that every deal was being created from scratch and was being designed. And from there, we have come all the way to this stage where I think there are many more typologies and ideas about things that have worked. We are seeing a huge amount of engagement from private actors. But I will say that the translation from that interest again to having an SDG loan fund to announce is slow and requires patience.
I want to make sure that folks actually know what we're talking about. Are there any specific examples that, in particular, you two want to highlight, just sort of show how Catalytic Capital works in practice?
Yeah. So about 3 years ago, Blue Haven was approached by this company from East Africa, Ampersand, that was very new, very fresh, and they were trying to prove a concept of you can use e-bikes in Kigali, in Rwanda, and you can, electric bikes, motorbikes, instead of charging the bike, you can swap the batteries. So the riders can save a lot of time because one of the challenges that with using electric vehicles is that you have to, take the vehicle to a charging station and then wait for it for the battery to be charged, and then you're losing a lot of time because you, as a rider, as a person owning the bike and using that to generate income, if a large chunk of time you're spending it charging, then that's opportunity cost. And so we're trying to prove this concept, and we're struggling with attracting investors because it was a new concept. E-bikes were just becoming a thing in East Africa. So came to Blue Haven, and we provided them with a Catalytic Capital loan, which they took, went to Kigali, bought 20 bikes, and they were able to prove the concept that, hey, actually there's interest in these bikes, and we can have charging stations where motorbikes can be, you can come in and swap the batteries. Within 12 months, the investor interest really had an uptick. They were able to repay back the loan. And 3 years down the line, I think earlier this year in March, they were able to raise $21 million in a structured finance deal. So it came from struggling to communicate that idea to and attract investors to a couple of years down the line attracting millions of dollars because they were able to prove. So from the power of just a small loan from Blue Haven, that was translated to receiving a large sum of capital, and now they've expanded to multiple countries in East Africa, not only in Kigali.
I think it's useful to frame the three pillars of catalytic capital that the consortium had documented in the first phase of the work. So if you read the series of white papers that have been put out, despite being critical of white papers early on, they are actually good white papers worth reading. And the three pillars are defined as seeding, scaling, and sustaining. So seeding really speaks to something's just getting off the ground. It's a first fund. It's early in its development. So for us, that might be something like Balloon Ventures, which is a SME lender in East Africa, or the Transform Health Fund, which we made a commitment to this year, which is providing mezzanine debt to healthcare facilities in Africa. And those, by the way, seeding it's a broad scale. So Balloon Ventures might manage $5 or $10 million now. Transform Health has raised $100 million. Both of those are seed initiatives in some way because they're brand new, right? So that's seeding. Scaling, overused term, but meaning moving through to kind of maturity in their development. So things like Gawa Capital's follow-on fund fits into that for us, their Kuali fund, or Lendable's new decarbonization fund as they scale as a manager to fund 2 and 3. And then the third pillar of catalytic capital is defined as sustaining. And these are investments that require some form of catalytic capital to persist in perpetuity because they won't graduate to some perfect future of commercial capital. So think CDFIs, which have existed for decades based on, low-cost capital, or high-impact MFIs that require also lower cost of capital, but can exist in perpetuity as long as there's a mix of philanthropic and catalytic-leaning investors in them. So those are, some examples in each of the categories.
Can I add to that? Yeah. So 2 quick things. One, I think the seeding, scaling, and sustaining framework is really important to also help you think about what impact or results you want to see. I think so with the seeding and scaling work, you will see this change in scale, volume, numbers. With the sustaining work, I think you measure the effectiveness of that capital partly by looking at the impact that work is creating, because you're not necessarily looking to grow significantly the volume and scale of that work, but keep it ongoing and keep the impact going from the underlying activities of the enterprises that have that sustaining nature. And you see this in financial inclusion, you see this sometimes in affordable housing. So those are the pieces. The other thing I wanted to add is that my colleague Charles Kustan is in the audience somewhere here. He's portfolio manager for the MacArthur Impact Investments team, and he and colleagues have been working on looking at the investments that were made within C3 by MacArthur. We call these field partnerships. And they've assessed, I think, as of late 22 or early 23, the enterprises that have received investments from the funds and partners we have supported have mobilized about 21 times the capital that was initially invested. And that's a significant number. It's a very short period of time, David, that we're looking at, a few years. So that should give you, and you know, the number runs into the billions at some point, right? So it is very, very powerful to see how these early but very strategic investments can transform the arc of what happens and how we really influence outcomes for people and the planet.
So let's get to some of these questions. They seem to be coming in. You have to write them down on cards, and Mark will find you. And make this quick because it can get very wonky. But folks want to know what is the risk-return profile on catalytic versus market rate. So if you can actually tell where that line falls, Greg or Daniel.
I mean, I guess I would say all of these things are so arbitrary and so contextual.
I knew it was going to be a long answer.
No, it's not a long answer. I mean, I guess, like, it's not useful for me to say 3%. Like, I guess I think even within our own judgment of an individual deal, we're constantly assessing what the right sort of cost of capital is on a transaction. There are places where that's going to be 2%. There are places where that's going to be 6%. It's entirely arbitrary to sort of name an interest rate. I think the same is true of people who sort of walk around pounding their chest about being some sort of commercial market rate investor. They're also making shit up. Like I just think that I just think what matters is context of a given investment and what the right cost of capital is in a given context to solve a problem and lead to a sustainable enterprise.
That's it. That's
Ditto?
it.
Okay.
He summed it well.
Can I add? I would say, I mean, if there were an easy, simple answer, then all of us would be doing very different things with our money, right? So there is no easy answer, and I think fundamentally directing our capital, catalytic or otherwise, in line with the underlying issue that we're trying to solve and what that finance is going to do is critical, because unless you start there, whether it is impact investing or catalytic capital, there is no way that investment is going to succeed. And that's some of the sort of basics we come back to all the time at Catalytic Capital.
There's a question about first loss capital and is it important, and could it be allocated from core endowments? And I think maybe the related question is there's, first loss and guarantees are slightly different kind of instruments. Guarantees can be put on the balance sheet, but you don't actually put the cash out. And those folks have thought could be very powerful because they don't get called unless there's a problem, and so you can use the balance sheet. But can first loss investments or first loss reserves be core endowment investments?
So I will not speak to the question on endowments because I don't think I'm the right person for that. But fundamentally, I think the point you're making is that whether it's a funded or an unfunded liability, right? So if it is funded, then it is coming out of some pot of money where you're putting the cash out and placing it elsewhere. We have seen a first loss capital being funded through grant monies, definitely, through also recoverable grant structures. So all of that is feasible. I think that I would say, you have to take a step back and see what the purpose of that capital or money is and what is the best way to provide that for you as an institution. And I think this kind of ties to also having a clear vision of what you as a catalytic capital investor would like to do. Because I think that what tools you can deploy at different situations will be a function of the context, the industry, what the investee needs, what others are willing to bring to the table in that moment. And you need to be grounded really in what your priorities are and what the different tools are that you would be willing to use at that time.
Yeah, I mean, doubling down on that purpose. So I think for us as Blue Haven, the thing that we really look at when it comes to catalytic investment is how additional we are to that structure. So additionality is, needs to come out very, very, very strongly before we make a yes and make that decision that this is going to be fall in our Catalytic Capital portfolio. If the deal can happen without Blue Heaven's capital, then we're not being additional, and therefore it's not a Catalytic Capital deal that we can take on.
This comes, I guess, comes off of that as well. For those of you making both direct catalytic capital investments and through funds, can you talk about whether one is more catalytic or can be catalytic than the other?
They're funny questions because I think they're all just contextual. I think there's a place for both of them, you know, there's a certain scale where doing lots of direct transactions is inefficient. So at the scale that we operate, it's very difficult for us to do loads of 500K transactions, direct transactions. We do them because I think, A, we like to do them, and it brings a sense of satisfaction for Diane and myself and our team to work on those direct loans. And it also makes us much smarter when we engage with fund managers. So we're going to due diligence on somebody who's made a loan to a company we've made a loan to. We know if they're kind of, we know if they're good or not at assessing that underwriting. So for us, we continue to have a direct portfolio. It's learning, it's satisfaction, but ultimately at the scale we operate, we're trying to build funds and intermediaries to do that work so that we can deploy larger, you know, we can deploy $3 to $5 million at a time in fund managers versus having to deploy capital in 500K increments. And then hopefully they're the ones going out and doing the 250, 500K loans. We obviously, though, without somebody at the end of the chain doing direct deals to companies that deliver goods and services to beneficiaries, this doesn't work. But it's all at what trickle-down level does one operate most efficiently?
But it just makes me think the follow-up question is, if you're providing essentially lower cost, whether that's lower cost or higher risk capital to a fund manager, is that concession, to use that word, flowing down to their deals with their direct deals?
Absolutely. I mean, and that's what we're selecting for. I mean, we are selecting for fund managers that are working in places where the cost of capital they need to be able to deliver to a borrower is lower than commercial rates could sustain. I mean, that is the fundamental math that trickles down through that equation. Everyone in that chain needs to be able to earn a reasonable living. I think, you know, we need to be able to earn something in expenses to pay our team. The fund manager needs to be able to earn a reasonable spread on what we lend to them and what they lend so that they can afford a team. And then ultimately, like an enterprise needs to be able to lend to borrowers in a way that works for borrowers, works for them. Like everybody in the chain needs a little bit to eat. So we just need to figure out how the math works, that at the end of the chain, we're delivering something to a beneficiary and a customer that genuinely improves their livelihood.
And increasingly, there are a lot of fund managers that are coming to market that are specifically designed to take in catalytic capital and redeploy it. So for us working in the climate space, we invested in Prime Coalition with the different funds, and we think Prime are fantastic at sourcing and deploying catalytic capital, especially in deep tech spaces that Blue Heaven we don't have the expertise to run diligence on. So we at Blue Heaven have expertise running diligence on energy transition as a whole, but when it comes to something like direct carbon capture or carbon sequestration, we don't have expertise in that. But Prime does have expertise in that, so we can deploy catalytic capital to Prime, and then they can go to market and source and provide that type of financing to these teams.
Great.
David, I think the conversation around fund managers also brings another very important lesson at C3 to mind. As soon as we started doing this work, and Prime, which you mentioned, Danielle, is a grantee, also an investee on our field partnership side. And they put together a little bit of a framing for fund managers. on how to think about their funds as catalytic capital funds and how to pitch that. I think what we've seen is that a lot of fund managers that are effectively deploying catalytic capital funds are very appreciative of the opportunity to have this language to talk about catalytic capital and the impact it creates without having to present their funds as close to market rate or doing things that are going to appeal to commercial investors. And I think we as catalytic capital investors have this responsibility to give the right language, framing, and the support to those along the chain, the fund managers, the enterprises that are actually deploying on the ground. And without that support, I think these fund managers find it much more challenging to articulate how challenging and how impactful some of their goals and their intents are.
There's a couple questions that go to sort of structures and term sheets and whatnot. So can you speak about the changes needed in legal systems to facilitate impact investing? And I think this is a pitch for the annual conference on law and social entrepreneurship in New York at NYU, put on by, your handwriting needs to be a little better. The NYU Grunin, is that right? Grunin Center for Law and Social Entrepreneurship. And then it's related, what are the financial structures and instruments gaining the most traction?
So I have a provocative answer to this question, which is absolutely no changes are required. We do deals. We do legal loans. We do them everywhere from, the US to Zambia and everywhere in between. And we have about 150, 160 transactions currently in our portfolio. We have never required any obscure, exotic change to a legal framework. The impediment to more catalytic capital, it's not legal, it's not structural. Like the structuring, let's be honest, we all work hard. We're not brain scientists, right? Structuring a blended finance facility, it requires a spreadsheet. We all get into it. We have fun chats about it. I'm not demeaning the work we all do, but it's not the hardest stuff in the world, right? Like the impediment to getting this stuff done is really the intentionality and the commitment of asset owners to direct their dollars in this way. There is a field of highly competent professionals who do the structuring work, who do the legal work. We can get this stuff done. Like, we do it every day. Lots of us do it every day. What we need are more asset owners to make the commitment to say, this is how I want my dollars operating. And then we can get it done. It's not to demean your conference. I'm sure it's a wonderful legal conference. I'm sure there's lots of interesting legal insights. But from my chair, we don't need changes.
Yeah, and and I applaud Greg's comments because we need many, many more investors like him, right? Who are focused on getting things done, who make the decision and then figure out what needs to line up for that to happen. And for some, that is more complicated if they have more complex structures or have more complex fiduciary responsibilities. For some, it's not. So I think I would say from my sort of field building hat, sitting at C3 grant making, this is something that comes up, sort of the transaction costs of trying to put things together, and what it takes, and what is sort of the optimal point where it's not too much of a pain, and certainly not enough of a pain to dissuade investors from participating, right? So I think we have seen different resources come up. There was the Impact Terms project, which Tonic manages now, and which has been set up some years back, which started looking at templates for agreements around financial innovative structures. But at the end of the day, I think you need a little bit of both. You need the conviction and the willingness to go all in that Greg is talking about, and you need a little bit of the other resources for those who are somewhere along that spectrum and not quite fully there.
And this is exactly why we've decided to partner with Urmi and MacArthur, so that she can nicely clean up my answers to make them much more digestible and politically correct. I appreciate that, Urmi. Thank you.
Two questions that are related, I think possibly from the same person. How do we solve the problem that fund models don't fit the needs of impact companies? And related, how can first or second time fund managers best communicate with potential providers of catalytic capital? So sort of like how do different layers of the capital food chain, as it were, fit together if they don't always speak the same language?
I'm going to invite Greg and Daniel to talk about this, because this, I think, came up repeatedly, Greg, in the Learning Lab roundtables that you all participated in, where people were talking about the fact that this was a huge gap that the fund managers were articulating.
In terms of how they communicate to us. Yeah, I think I could say how not to communicate to us is to bombard our inbox with repeated pitches. But
Well, it could work.
It could work, I guess. I don't know. I don't know that there's. This is not a problem that is unique to the impact investing field, right? If we were at any investing conference, kind of first-time fund managers or second-time fund managers in general would be complaining, or complaining is the wrong word, would be frustrated about how to best reach asset allocators. And asset allocators would probably also feel frustrated about receiving lots of inquiries that don't fit their mandate. I mean, I could show you my inbox. I've got lots of pitches for cryptocurrency. It's like, has anyone, read that we're impacted by it? So I think there's frustration in both directions in terms of trying to make efficient connections in the best way possible. I'm just rambling for a non-answer here because I don't really know. I don't really know what the best way to communicate. I would say the more you can learn about an investor, the more you can really understand their mandate before you approach him or her, the better. The idea that you're somehow going to have an idea that's so great that like you're going to move them away from their mandate, I think is a bit sort of fantastical, right? Like we all as institutions, even those of us that are flexible, are pretty directed and focused in what we're going to do. So the idea that like you have the greatest mousetrap that I know Ceniarth doesn't do venture equity, but like you've never heard my idea. It's so great. You're going to want to do venture equity in me. Like that's not going to work. Like I think, just understanding what people invest in is probably the best way to approach them.
And I think also allowing time for, even in the subset where the strategies fit, allowing time for the relationship to grow organically. So a lot of the time it's like, oh, I presented to you on a Monday and I want you to tell me if you're going to invest to me in my fund on the Friday. And at the end of the day, it's a relationship business, and so you need to allow like a little bit more bandwidth of a couple of months of getting to know each other, especially in fund ones and fund twos where the track record is limited. So having that flexibility, on the fund manager side of allowing for that organic relationship to develop.
Yeah, I know there's not much sympathy for an asset allocator to say it's sometimes just hard to tell people no, but like it is. I think it's been a hard learning for me over a decade of doing this job. I used to be on the other side of this. Like for the previous 15 years, busted my butt every day trying to raise money. So like I get it. And so as soon as I got in this chair, I found it like painful to like actually have to be like, no, we're not doing it. We can't do that. No, I mean, but there's not there. No one needs to cry. You know, that's the thing. No, I mean, I'm in a very privileged position now, so I don't. No one needs to cry us a river. But I do think that sometimes we should be saying no, you know, clearer, faster, more efficiently, and sometimes we just get hung up and don't do that, and it's actually not useful for either of us. So, you know, we'll try to be better about that too. When it's a no, we'll try to be better about saying, you know, I met with somebody yesterday and I said, you know, we can't do this now, but if we were never going to do this, I would tell you we were never going to do this so that you didn't check in with me quarterly. But I think trying to be direct in communication is the best we can all try to do.
So I'm going to ask you just a very quick question, and then we have the one last that will also serve as your sort of final thoughts. The yes or no is, do you fund initiatives or invest in impact funds in India?
We don't, as Blue Haven. We do a lot of work in North America and Africa, but we have some investments in India, but it's not our core.
So just to the previous point, don't send India pitches to Daniel.
Credit funds, yes. Anything that's not debt, only if your name is Mark Kahn at Omnivore. Yeah, that's where we would.
And
MacArthur is not focused on anything in the emerging markets right now, except in some very specific themes.
Great. Okay, so this can serve as the sort of your final thoughts as well. How can we help more wealth holders operate like Ceniarth and Blue Haven? Which is, just take broadly, how can you bring more capital in, more catalytic capital into the
yeah, I mean,
impact first
I think that you can introduce them to us. Like, I think Diane is always fond of saying that, you know, she would try to influence billionaires if she knew any. You know, we think we're fairly good at influencing other wealth owners when we can get into those conversations. And we have provided lots of resources to the field. We're an open book for asset owners with significant scale that are trying to do this work. In the last year, we've actually formed an incredibly successful partnership with another family office that operates anonymously, that wanted to deploy more capital, that is willing to sort of work with us in a very collaborative way. There's no business it's, you know, simply us sharing deal memos, and that one relationship has unlocked tens of millions of dollars even in the last year, just through that kind of collaboration. So, you know, I think that we just somehow need to be in front of more of those asset owners. I just don't, they're not here. So I guess I need to do a better job of finding them. And if you know them, send them our way.
Send them our way too.
Yeah, yes, and I think it only takes one catalytic capital deal to be a catalytic capital investor. So if you have, you know, 99 deals that are just, you know, impact investing, traditional impact investing, and then one of them to make it 100 is a catalytic capital deal, then you are a catalytic capital investor, because that's all it takes. Identify a problem area in any theme that you're serving, and as long as you can have additionality and show that, demonstrate that your deal is actually unlocking additional capital in that space, then you are a catalytic capital investor. And through that deal, then you get invited to these spaces with Ceniarth and C3, and you're able to continue learning. The warning on that label is that one deal is going to be a gateway drug, because it's so much fun working on the catalytic capital space. You'll end up with a huge portfolio.
Yeah, I mean, that question, David, in some ways, is why C3 exists, right? We believe that there are ways to be thoughtful about getting investors engaged, and through the work that we've supported, it's ranged all the way from producing those research reports and analysis of work done, to actually having tools and masterclasses and trainings for investors to start thinking about catalytic capital transactions and what it takes to be part of those. So I think the answer is complex, but I would also say it is very, very inspiring in this moment to be launching this next chapter for C3, because we've seen huge interest from investors that are at various stages of engaging with Catalytic Capital, all the way to the leaders like those sitting next to us today, to folks that are just dabbling their feet even in impact investing and have not thought about, getting even into Catalytic Capital fully. Two of our grantee partners that are networks, one is Latimpacto in Latin America, the other is Tonic in the US, has seen huge interest from family office members that want to get into this, that are looking for some handholding, that are looking for investors that know a lot more about this work to lead them into it. So I think the more structured and thoughtful we can be with the resources and partnerships and collaborations we're creating, the more we can open those pathways.